In today's video, we're going to talk about exchange-traded funds, or ETFs. An exchange-traded fund is a type of investment vehicle that invests in a variety of assets, such as stocks, bonds, or commodities, and trades on a stock exchange like individual stocks. ETFs are designed to offer investors a way to buy and sell a diversified portfolio of assets in a single transaction. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. I'm going to review the key features of ETFs, including diversification, low costs, liquidity, variety of investments, and fees associated. ETFs diversify investments by pooling together a wide range of individual securities into a single fund. This structure allows investors to spread their risk across multiple assets, reducing the impact of poor performance by any one security. Diversification is achieved by holding multiple assets via a broad market exposure or multi-asset classes. Broad market exposures often track a specific index like the S&P 500 or the NASDAQ. By doing so, you will gain exposure to all the companies within that index. Multi-asset classes includes a mix of stocks and bonds. By incorporating multiple asset classes, investors reduce their overall risk. ETFs generally have lower expense ratios compared to mutual funds, making them a more cost-effective option for investors. This is because many ETFs are passively managed, meaning they track a specific index, like the S&P 500, rather than trying to outperform it. Passive management requires fewer resources, such as research and analysis, compared to actively managed mutual funds, where the fund managers regularly buy and sell securities in an attempt to outperform their benchmark. ETFs have greater operational efficiency on the back end than mutual funds because ETFs are traded on exchanges like stocks. The buying and selling of ETF shares occurs between investors on the open market without requiring the fund itself to buy or sell the underlying securities. This reduces the trading costs and taxable events within the fund. ETFs are traded on stock exchange, so they can be bought and sold throughout the trading day at the market price. This provides liquidity and flexibility for investors, allowing them to react quickly to market changes. ETFs are bought and sold on stock exchanges just like individual stocks. This means they can be traded throughout the trading day, providing real-time liquidity. Investors can buy or sell ETFs at any time during market hours, and the transactions are executed almost immediately at the current market price. Unlike mutual funds, which are priced only at the end of the trading day based on the net asset value, or the NAV, ETFs have continuous pricing throughout the trading day. This allows investors to react quickly to market conditions and execute trades at a specific price point. Majority of ETFs trade on a secondary market with other investors. If there is not enough supply or demand in the secondary market, authorized participants, such as large financial institutions, can create or redeem ETF shares by exchanging them for the underlying securities. This creation and redemption mechanism ensures that the supply of ETF shares can meet market demand, enhancing liquidity. Lastly, many ETFs are highly popular and heavily traded, especially those that track major indices like the S&P 500. Higher trading volumes contribute to greater liquidity, making it easier to buy or sell shares without significantly affecting the price. ETFs are available for a wide range of asset classes, including index ETFs that track a specific stock index like the S&P, the Dow Jones, or the Toronto Stock Exchange. Bond ETFs, which hold a portfolio of bonds offering exposure to fixed income securities. Bond ETFs can be comprised of government bonds, corporate bonds, and high yield bonds. Commodity ETFs invest in physical commodities like gold, oil, or agricultural products. Sector and industry specific ETFs focus on specific sectors or industries such as technology or healthcare. International ETFs provide exposure to global markets or specific countries. Like any product or service, it comes with a cost. The cost of an ETF to investors is known as the management expense ratio, or the MER. The MER of an ETF operates similarly to that of a mutual fund. it represents the total annual expenses incurred by the ETF, expressed as a percentage of the fund's average net assets. The MER includes various costs related to the management and the operation of the ETF, such as management fees, which are fees paid to the fund manager for overseeing the ETF, including the costs associated with managing the underlying portfolio of assets. Administrative and operating costs are the costs related to accounting, legal services, custodial services, and other administrative tasks. This may also include fees for listing the ETF on exchanges and their marketing expenses. And there may be some additional costs with ETFs, which can include licensing fees for tracking a specific index. MERs on ETFs can affect investors in multiple ways. Firstly, they can impact returns. The MER is subtracted from the ETF's return before they are passed on to the investors. This means that the performance of an ETF is reported to investors net of its MER. ETFs generally have lower MERs compared to mutual funds, which is one of the reasons they are popular with cost-conscientious investors. Lower MERs means that the more of the ETF's return are retained by the investors. Overall, ETFs are a great way for retail investors to diversify their capital. There are options for investors of all risk tolerances and objectives, and with careful due diligence or selection, you can construct an ETF portfolio to help you towards achieving your financial goals.